So I think just educating, reading books like that, and then just networking with people that you're building relationships with. Whether or not you plan on investing today or in 3 years, 4 years, you really are the outcome of the relationships that you've developed.
Are you ready to transform your life? This is a no-nonsense show helping immigrants like you create generational wealth, even while working full-time. Get ready to take notes. Here's your host, Saket Jain.
Welcome back, Migrate to Wealth listeners. Today, we have the pleasure to talk to Denis Shapiro. He's one of the few podcast guests that we have so far who is operating multiple asset classes, who is pretty bullish on a lot of them as well. We thought bringing him is actually going to be very helpful to give you a perspective of somebody who is not only raising capital or co-partnering with the asset managers on different asset classes, but is actually an operator and an investor. So that's really what we thought we'll bring Denis for. Denis, how are you, buddy? Thank you again for jumping on the podcast.
Doing great. Thank you for having me.
Yeah, Denis, before we actually go into your full-fledged introduction, which is going to come out, I want to ask a question. When you think about migrate to wealth, what does that mean to you?
So personally, I come from an immigrant background. I wasn't born in this country. So we came here with very little, the typical, only the dollars in your pockets type of thing. So Migrate to Wealth is just about this lifelong journey of growth. And it's not only a financial journey, a wealth of knowledge, especially knowledge in terms of relationships. That's what I think of when I think of Migrate to Wealth, of just bettering yourself, growth, and bettering others around you.
Yeah, no, I think that's the essence of our show. So thank you again for imbibing that spirit. So Denis, what is your story about migrating to wealth? Help us understand that.
Yeah, so I started fairly young when I was in high school. My oldest brother gave me a copy of Rich Dad Poor Dad. I read the book, disliked it at the time because I thought he made more money on his tours and his book sales than what he was actually talking about. I was a little bit of a cynic, but I did get started investing. I started with stocks.
So Denis, help us understand what is your migration to wealth journey?
So I started fairly young. My oldest brother gave me a copy of Rich Dad Poor Dad when I was in high school, read the book. I was a little bit cynical on the book at that time just because I thought he was making more money on his book tours and book sales than what he actually preached in the book. But I got started investing in stocks at the time. I went through high school, wanted to be the next Warren Buffett, got out of college, right in the smack middle of the global financial crisis. So I couldn't find a job, couldn't find anything. So I did, the logical thing and went back for more school because that's always the answer. So I went back for my MBA. During my MBA, I got recruited by the government. I started working for the government. And then I got my first W-2 paycheck. And I was like, wow, the government's not only my employer, they're also my business partner with the amount of taxes they're taking out.
And silent business partner.
Right. So I Googled, how do I pay less taxes? The first couple of answers were semi-illegal. So then I actually went back and said, how do I pay less taxes legally? And the first 10 things were all real estate related. So then I did probably the stupidest thing you could do. I asked my older brother, who had a portfolio at the time. I said, well, do you have any property that you want to sell? I kind of need write-offs. So he looked at his whole portfolio. He's like, oh, this one's the biggest headache. And he gave it to me. And then that was a single family in a low income area. And I cut my teeth on that property. There was not really enough money for property management, but I made every mistake under the sun. And then I realized, I kind of wanted to go more passive at that point. I was still working full-time for the government. And that's kind of when I found out about securities and syndications. And I did my first syndication when I was just as an LP in 2014. I grew that side of my portfolio substantially. And then in 2018, I actually created an investment club where two other individuals found out what I was doing, wanted to kind of participate. So I got together with a couple other individuals. We started co-investing in various LP deals. That actually allowed me to get a lot of data and allowed me to actually see which deals work, which don't work, because I was doing a lot of higher volume of those kind of deals. And then when I started really looking back at it, I kind of started pinpointing things that I would do differently. And then once I started thinking that way, it was like a pathway I ended up doing a couple of joint ventures. And then from there, I got on the full side of just the operational side. So it was definitely a long journey. It wasn't overnight, but it was a 10-year journey of, being just an LP to doing an investment club to doing JVs and then to switching over and doing general partners.
It's awesome. Dennis, thank you again for going to that breakdown of your journey. One thing I want to ask is about passive. Let's start from passive, right? Because you picked up a headache from your brother and you asked for it. It's not like he gave it to you. So, and then you realized what was going through your mind that made you move into passive? Is it just amount of work or lack of understanding? What was your reason? Of course, you're also working full time. So what made you go heavy on passive investing?
So that's a good question. So the first thing is I was looking at the amount of time that I was spending on this one single family. And then I was like, well, to make significant money, I would need 30 of these. And then I said, well, if I times 30 by the amount of time I was spending here, this would be impossible. So one, I just thought from a time perspective, it wasn't really a good use of my time. Then I started researching more passive ways of investing. And I found like hard money lending, and I think it was like distressed mortgages. But at the same time, didn't want to go through the path of figuring out how to do all of that stuff myself. And then I found the fund that was actually doing it. And then I just put two and two together. I was like, wow, this is a lot simpler, good track record. I was like, let me try this approach and get all the benefits of that asset class without actually doing all the homework. And, these days, much more educationally focused before investing in the syndication. But at the same time, when I was 10 years ago, when I was first starting out, your learning curve is so significant that, if you read the high level marketing of some of these places, you're like, oh yeah, I know what they're talking about. Let me just invest. So it was one of those situations a decade ago.
Yeah, and also I think if you were to understand every single thing, then you'll never invest. So I think it's a fine balance between the two. So Dennis, at that point, when you shifted from managing that one property that you bought from your brother to now investing passively, were you still investing in single family, or did you pick a different asset class?
No, so that's when I did the note fund after that. And then I went...
That's it.
Yeah, I did the note fund passively as an LP. And then I got into multifamily syndications as LP.
Got it. And note, let's talk about note for a second, because I think we have a few guests who've talked about notes a little bit. When you were looking, so thinking from what triggered you was the government being a silent partner for you in your taxes, and you have to pay them taxes, right? And of course, having a single family would have helped a little bit there. But how does the note help, or did the note help in your tax savings at all? Or was the reasoning at that time I shifted to more passive income and tax saving?
Yeah, at that point, it shifted over to just more passive income. That single family really did the trick in terms between single family and then, 401k investing really lowered my tax considerably. So at that point, it was more switching over to passive. Note funds in general are not really great tax vehicles unless you're doing it in self-directed, because there's less depreciation to offset the income that the fund is producing. So it's the balancing act, because the cash flow is going to be better than what you'd get in a typical multifamily syndication. But at the same time, if you're a high earner in a high tax bracket, it might not always be the best thing for you unless you're doing it through a self-directed.
Yeah, no, I couldn't agree more there, Dennis. So Dennis, let's fast forward from the journey. So now, assuming, are you still with the Fed, or you're now done with the job?
Yeah, I semi-retired last year. So we ended up in a spin-off business related to what I was doing for the government, but it's for myself, and that's a separate entity than the real estate holdings.
Got it. So now let's focus on the real estate for now, and then we'll go on the other one if there's a need. So when we look at now your real estate portfolio, I'm assuming you're more active now. You're still active and passive together. How does your portfolio look right now for real estate?
It's definitely transformed from 100% passive, I would say 3 to 4 years ago, where I still have a few passive deals going through its life cycle. But at this point, our company, Insights Capital Group, we don't invest in any opportunity unless we have some kind of operational insight. Okay. And that goes from everything from completely running the project like we do on our affordable housing side to just to joint venturing where we're not the lead operators, but we have access to the property management software. We sit on the calls, we visit the property. We do that with certain asset classes like self-storage. So we do a little bit of few different asset classes, but it's more based on partnerships than fundamentals of that asset class, because I'm a firm believer of, at the end of the day, it's really the operator that's going to make a good deal. So that's kind of
always. I think you're less. I think sometimes, especially the environment right now, is less about the asset. It's really about the operator, because a good operator in this market can turn a bad deal around for good.
Yeah. One of he always said, I don't want to butcher, but he always said a good operator could make a bad deal whole.
Yeah.
And that operator could make the best deal negative, or like the loss of something that nature. So I've always subscribed to that. And that's why we've switched where even if we're not the lead operator, and usually we are, but even if we're not the lead operational, we're not just writing out checks and saying, okay, here you go. And that's forced us to really partner with certain type of operators. So we can't really go out and partner with, someone who has $500 million in assets under management, because we don't provide them any value. But someone who has, let's say $10 to $20 million in assets under management, and we could come in, then we provide tons of value, and we almost come out like a board of directors for that deal, because we've seen so many deals.
Sure.
So it's all about providing value to your partners and to your investors.
Yeah, no, I agree, man. I think that completely makes sense to me. I think the world is shifting anyways. There's going to be a need for good operators moving forward. The times that we were living in 3, 4, 5 years ago has drastically changed, because at that time I was even hearing folks saying, just buy something, your mistakes will be corrected by the market. Just not a good way to buy, right? Those times have shifted. Those times have gone.
Yeah, and a lot of people are getting out of the business. And unfortunately, some syndicators have, I think, created a bad stigma to syndications. We tend to partner with operators who are second generation. Like we have one partnership with a mobile home park operator. He's around my age, but he's bought his parents out 10 years ago. And then he's expanded from 3 to 12 parks.
Right.
So we're coming in and we're partnering with him because he's been able to kind of burr out these mobile home parks one after another. The burr strategy right now is dead because of the interest rates. So all of a sudden right now, he sees us and our 5-year relationship together where he's invested with us on certain projects. And he sees that as a logical stepping stone where he doesn't have an investor relationship. He doesn't have anything. He's literally used family money to acquire one property at a time. Those are the operators. We're not trying to partner with a new operator that's been doing it for a year or two. That makes no sense to us. But if we could find someone who's got a decade plus of experience, and his family had like 40 years experience in the mobile home park space, has geographic focus in a certain area, like he owns 11 out of the 15 parks of that MSA. So when we find things like that, we really embrace those partnerships. We really provide maximum value. And that's what allowing our investors to get access to deals like that is kind of what we're special, what makes SIH Capital Group different and special.
Perfect. Now that makes sense. And Dennis, I know we opened the show up with, right now you have access to multiple asset classes that you are either invested in or you're operating in. It seems like as forward, unless you have an operational insight, even if you're not the lead operator yourself, that's the goal moving forward. So help us understand, what asset classes are you bullish on right now?
So number one is affordable housing. That's our bread and butter. When it's any affordable housing deal, we are the lead operator on that. Because that's where we're going out to acquire.
What does that mean? I'm sorry to interrupt you. What is affordable housing? Because it could mean a lot of different things. So it could mean a mobile home park. It could mean, the apartments that have affordable ADUs. It could mean a lot of different things. Could you explain to me and our listeners what exactly you mean by that term?
Sure. So we deal in the low-income housing tax credit space. So basically, the government incentivizes developers to build affordable housing. The way that they do it, I like to explain it this way. If you have a raw piece of land, the cost to build that raw piece of land is surprisingly similar with affordable or a Class A beautiful property. The reason is you need the foundation, the electric, you need the plumbing, you need roofs, you need the windows, you need all But what's different is that last mile of finishings, right? Instead of quartz countertops, you're probably putting laminate countertops with affordable housing.
Sure.
So no builder would ever turn around and, by the goodness of their heart, build a brand new building and then just say, well, we're going to just put this as affordable. So the way that the government kind of incentivizes them, they give these low-income housing tax credit, and it allows the developer to build communities, and then in exchange they get huge credits, and then in exchange their property is subject to income restrictions usually for 2 15-year periods. So during the first 15-year period, they're highly incentivized to keeping that property because of all the breaks. In that second 15-year period, those restrictions they're still in place, but the credits are no longer there. So they tend to look to sell at that point, and that's when we come in and we look to buy. So these are townhouse communities. They look like your regular Class B properties, but what you get is that we can only put in people in there that have certain income restrictions in there. And on top of that, we also deal with vouchers, like your project-based vouchers or tenant-based vouchers that people call Section 8. So it's a little bit more complicated because it's multifamily that's less dependent on value add. We have a waiting list to get into our properties, and then we get a certain amount on the first of the month, we get a certain amount of the rent paid by the government. So we really like the model. The waiting list is there, like supply and demand just gets worse and worse when it comes to affordable housing. There's also a barrier of entry. If you're a new operator, you're not going into affordable housing. It's a lot of bureaucracy. It's a lot of red tape. You usually have to be approved by the state to even get to close on that property, because the state doesn't want anybody just taking over that affordable housing community, because things have gone bad before with other operators. So it's the only commercial real estate space that I know that has a real competitive barrier to it. And it has a huge waiting list, and you don't have to go in there and renovate these apartments to put brand new fixtures. So we really like the space.
Dennis, which markets are you in right now for affordable housing?
We're actually in the Northeast. So we are in the Pennsylvania area outside of Philadelphia. We don't like to go to Philadelphia because it's too tenant friendly, but we like the fairness. So we're outside of Pennsylvania. Two of our partners are from Pennsylvania, and I'm from New Jersey. So we like to stay somewhat local.
Got it. So is it in New Jersey or is it in Philly? Where is it?
It's in Pennsylvania. It's in Chester County, Pennsylvania. Our affordable.
Awesome. So what are the other asset classes, Dennis? I know we talked about affordable housing units as one. What are the others?
So we do have a short-term rental division where we buy short-term rentals, but at scale. So multiple units on one property. We don't believe in the whole single family scattered around type of portfolios that you kind of see right now that's going mainstream in the short-term rental space. So we have 9 beach bungalows in the Jersey Shore area. It again has its own barriers of entry, extremely high cost per unit, but you're getting an extremely high dollar rate. And there's also great plan Bs and plan Cs if the short-term rentals don't work out.
And are you managing them yourself, Dennis?
We have, so both on the affordable housing side and the short-term rental side, we have built out management companies to oversee them. We're a firm believer of vertically integrating property management. When I was doing my investment club, the number one reason an operator would give for a deal is bad property management. So fairly early on, that was a core focus of us. You know, we're not 1,000 units, but we focus on high occupancy. Our affordable housing is almost 100% occupied. Short-term rentals, we do great. And the only reason why we could do that is because we oversee our property management ourselves.
Awesome. Any other asset class, Dennis?
So we had joint ventured in self-storage. We're not the lead operators there. And we're also buying right now residential, commercial real estate. That's not really affordable housing, but it's in Ohio, where we're using a strategy that we really like right now, where we're buying basically all cash, smaller multifamily, or, you know, have like a heavy down payment of 50% or greater. The goal is to buy it, hold on to it until the interest rates go down, and then refi out. So we just did an acquisition like that in October, and we're looking to do more acquisitions.
Why in Ohio?
So it's only 7 hours away from So it's 5 hours away from our other property. So it's actually not that far. And it's just one of the partnerships that we've developed. Is out there. He has the uncanny ability of getting these deals. So they're not broker related. He has great relationships with older sellers that are looking to pivot out. So we're able to negotiate, seller financing in these deals. And it's just the way it works out. We're not really active on acquisitions. We really just have these strategic partnerships where they kind of have the deals. They bring the deals after they're kind of vetted on and they're in contract. And if we come in and partner on them.
Got it. And Dennis, are you able to share which market in Ohio it is?
Yeah, it was in Canton, Ohio.
Canton, Ohio. Got it. Awesome. Well, Dennis, I know we're running short on time here, so I'm going to quickly switch gears here. In the last 20-ish minutes, is there anything that you believe our audience would benefit from that we haven't discussed, haven't had a chance? I'm sure there's a lot that we haven't had a chance because we just barely scratched the surface. So are there some key insights, one or two insights that you can share with the audience that's going to give them an edge as they delve into the investing in this tumultuous times?
Yeah, I would say right now is a great time to focus on just educating yourself. I published a book, The Alternative Investment Almanac, Expert Insights on Building Personal Wealth in Non-Traditional Ways. You can find that on Amazon. And basically, I wanted to summarize everything I was learning for the last 10 years and being an investor. And the way we structured that book is that we have an introduction to the asset class. So, like, for example, self-storage, multifamily, mobile home parks. You'll get an introduction into the actual asset class, and then you get a Q&A, and it's the same Q&A for every single investor I interviewed in this book. And I interviewed 2 investors per asset class. So it's a great way to really dive into a certain asset class without spending without reading 400 pages on one specific asset class. So you could read it, lending versus, multifamily, and then make a decision for yourself, this is better or this is not. So I think just educating, reading books like that, and then just networking with people networking with people that you're building relationships with. Whether or not you plan on investing today or in 3 years, 4 years, you really are the outcome of the relationships that you've developed. And I'm a firm believer in that. So even if you're not doing deals, don't waste the time and spend time talking with people who are either investing or what they're seeing in the market. And that will, those type of returns are exponential.
Awesome. Dennis, this is amazing. Thank you again for jumping on. I wish we had more time with you. I don't know, you're busy as well. So what we'll do is we'll probably set up another call with you to do maybe a detailed webinar. And thank you again for sharing your book's resource. We'll make sure it's included on the show notes below. Well, thank you again, Dennis. Appreciate it, buddy.
If you got value from this episode, you might consider sharing this content with a friend. But most importantly, be sure to take action on what you've learned. One way you can take the next step is to connect directly with Socket on an investor call. That link is waiting for you in the show notes below.